Hey everyone, me Kevin here. In January, we talked about how good news was bad news and bad news was terrible news. The reason for that was in quarter one, we were looking at the market coming off a high and thought, oof, if we have any, miss in earnings, stocks are gonna plummet. And January was really sensitive to that because that's ultimately what ended up happening to a lot of companies. Earnings came in not so great. And everything started with a canary in the coal mine going straight downhill with Netflix missing terribly. Well, then we thought, though, bad news from earnings reports will be bad because valuations are coming off higher levels. But good news is also bad news. That's because any kind of good news that we get on a strong consumer or strong demand would encourage the Federal Reserve to hike faster. And unfortunately, that's exactly what they had to do, going from maybe 25 basis point hikes to reports continuing to come out that the consumer is just continuing to spend money. And what happened? We ended up getting 50 basis point hikes, and then they'll never go for 75. Oh, and sure enough, they go for 75. Well, folks, there's a really big memory going back to January that, hey, wait a minute. Maybe these last earnings reports weren't actually that good that we just had here, Q2 earnings. The ones in January were actually Q4. It was in Q1. But anyway, so these last Q2 earnings maybe weren't actually that strong. And maybe the good news that we just got this morning is actually going to be the kind of stuff that the Federal Reserve needs to say, you know what, we just got to keep cranking the wrench and crushing this economy. And that has a lot of folks saying, we're ready for another big downside in the stock market. Now, let me explain what I'm talking about. First of all, we've got the NASDAQ testing the 50% Fibonacci retracement line right here. You can see that simply by going from the top to bottom. That's 100% to zero. From zero, back up 50%. We are back up a full 50% retracement from the lows of June on the NASDAQ. And that is a testing point. If we hit this test point, just like when we were sitting at the 38.2 line, there's a good chance we're going to see some resistance, just like we've seen here at the end of the day yesterday and sort of in pre-market and the end of the day on the Monday as well. And we're seeing a little bit of a pull down here in pre-market already. Now, why could that potentially be? Well, that could potentially be because of this memory of good news is actually bad news and bad news is terrible news. See, this morning we got retail sales data, for example. Economists were actually expecting retail sales data, excluding autos, to fall 0.1%, which annualized would be a fall of 1.2%. And the thesis goes that, hey, well, if consumers finally spend less money, then inflation has to come down, right? Because retailers will be forced to cut prices, and when they're forced to cut prices, then we'll get disinflation or potentially even deflation. Well, they didn't come down 0.1%. They actually went up 0.4%, which all of a sudden means we're actually still growing retail sales at 4.8%, which might just be the pace of inflation, but it's still a concern because, that could be all companies need to continue to get pricing power. When you exclude autos and gas, we are expecting to get a surveyed increase. So this is your core retail spending. We're expecting a survey of 0.4%, which is 4.8% annualized. And what did we actually get? Well, we actually ended up with 0.7%, which represents 8.4% of a core increase annualized in retail spending. And this is sending a signal to the market saying, hey, whoa. This is all the ammunition the Fed really needs to continue to say, dang, our job is to destroy demand. Like, we can't fix the supply curves. That's it. Let's just hike more. And so some of the overhang that we're going to see over the next weeks and months is going to be that there is still this lingering belief of good news is bad news. But I have a different opinion about this, and I want to tell you why I think we might actually be past good news is bad news right after this message from our sponsor. One of the most time-consuming parts of my business is paying business bills, which is why I'm excited that today's sponsor, Melio, decided to reach out. Imagine you're like me, running a small business and hiring out countless contractors to make sure everything is running as smoothly as possible. Now, imagine the stress of all these contractors only taking in-person checks or other types of payments that you just don't have the infrastructure set up for. Well, thankfully, with Melio, you can pay any invoice however the heck you want. You pay with a bank transfer, completely free of charge. Or you pay with a credit card. Yep, even where they don't accept credit cards, you can earn points and cash back while paying business bills, not to mention the option of deferring payments by up to 45 days. Using Melio has allowed many to spend time and save endless amounts of money where it really matters. So that way we can spend more time creating content or making money in our business. There's no need to spend hours on writing and spending checks. You can pay online and Melio will send a check on your behalf. All you have to do is add a vendor, upload a picture of the bill or invoice, choose if you want to pay by credit card, bank transfer, or whatever you want, and that's it. It also seamlessly syncs with your QuickBooks account, which eliminates the dual entry that you have to do ordinarily, and it just makes your life much easier. So start saving time today by using Melio with a link down below in the description. Again, link down below to join the future and start making payments with Melio today. So why could good news on consumers continuing to spend actually be great? Well, first of all, it means we're still propping up earnings, at least to some degree, for the amazing companies that are becoming so much more efficient in the markets right now. These are amazing companies in America right now. You can't bet against America. And they're becoming more efficient, unfortunately, by laying off people and being more disciplined with their spending and their advertising, which is bad for certain sectors and certain companies. But some of these larger tech companies are killing it for a reason. There's a reason Apple is close to 6% of all-time highs. It's because not only are they able to become more efficient, but consumers are continuing to spend more money. So why isn't that bad, though? If the consumer continues to spend more money, Kevin, why is that not terrible? That should be a sign the Fed has to work harder. Not necessarily. And the beautiful thing is, the Federal Reserve is looking at inflation. As long as inflation moves down, we could actually see the Fed take a more soft and steady approach to get to that 3.9% Fed funds rate by the end of the year, maybe 3.5, somewhere between there, 3.9 to 3.5, and stay there. And then just relax as inflation slowly bleeds down. But Kevin, how can inflation slowly bleed down if consumers are still spending like madmen? If every quintile of consumers have more money than they did compared to last year and compared to 2019, and consumer spending is actually ticking up and not down, how come the Fed wouldn't try to crush us? The answer is simple. We could actually see inflation go down, disinflation, while at the same time, consumers are spending more. Now, that's the mind-blowing point. See, most folks are associating more spending with more inflation. But let's be real. Between 2011 and 2019, we spent more every single year. And we did not have an inflation problem. Why? Because we had enough supply. That's the bottom line. We had enough supply. So there was no massive upward pressure on prices beyond the usual 1.5 to 2%. The same could happen now. If we have a glut of inventory at companies like Walmart or Target or the chip manufacturers or Apple gets enough inventory, then the pressure on pricing is not there to keep pushing prices up, even though consumers continue to spend. That is good. See, what we want is consumer spending. Let's think about this sort of just as an example. If consumer spending goes from 100 to 102, that's still 2% consumer spending growth, right? If supply goes from 100 to 101, well, now we have a lack of supply. And so prices go up. That would be bad. We don't want to see that. But instead, again, consumers go from 100 to, let's say, 102, and supply goes from 100 to 103. The necessity to raise prices goes away. So as long as you believe that companies have worked hard to solve supply chain nightmares, and even though we know they're not all solved, as long as you think they're solved enough to hold or to handle an increase in consumer spending, an increase in retail sales, which means that inflation will continue to go down, you could actually have a phenomenal next 12 months in the stock market, as long as this is correct. Because if inflation starts breaking to the upside, then this thesis is wrong and you'll lose money. But if my thesis is correct, inflation will actually bleed down. The Federal Reserve will get to about 3.5 to 3.9% and pause. We'll see inflation bleed down while at the same time consumers are still spending more. People are going to go, what? How is this even freaking possible? I thought more spending meant more inflation. No. This inflationary crisis was a supply crisis. That's it. We always see consumers spend more money and we don't have an inflation problem. Don't forget that. So, retail spending going up, earnings coming in positive are not necessarily bad news. They were bad news back in January because valuations were ridiculous coming off the November, December highs. So remember that. We're in a different place right now. Now, do I really think that we should be retracing back to 100 on the NASDAQ, let's say, back to all-time highs anytime soon? No, not really. But this could be good news. Thanks for watching.